one of the stars of business TV and radio. Let me just say that Doug Dachille and I go back to the late 90s when he was the head of proprietary trading for J.P. Morgan at the ripe old age of 34 or 35. And most significantly, the reason I knew that Doug and I were going to hit it off was one of the first things he did was when tips were issued for the first time. They know that I'm tips crazy. He bought $2 billion worth for the proprietary account.
But I did it even better, see, because he loves tips, but I hate tax. So what I did, he buys the tips and pays the tax. But what I did at J.P. Morgan is I bought the tips and avoided the tax, because what I did at J.P. Morgan is I put them inside the life insurance policy, the corporate-owned life insurance policy of the firm. So I was able to enjoy not only getting a real yield of 4%, I was also able to enjoy inflation tax-free. Because unfortunately, the problem with tips is actually they don't hedge you against inflation. Because when inflation goes up so much, the fact that the government taxes you on the inflation, you actually wind up having erosion of your return. Because if I buy tips right now at a 2% yield and inflation goes to 10% and the government taxes you at 40% on that, you're actually going to have an after-tax return that's lower than the rate of inflation. So you actually have erosion of your purchasing power even with the thing that gives you the most inflation protection because of the government's taxation of inflation. So I've been advocating if you're going to offer tips, you might as well offer the inflation component of that to be exempt from tax. Because otherwise, the instrument itself does you no good in hyperinflation environments because they tax away the hyperinflation. So, and you wind up not preserving your purchasing power. So when I tell people to own tips, I tell them to own those tips in their life insurance policies. And you can speak to my colleague in the corner. He'll teach you how to do that.
I'm about to introduce Rob Lewis, who is partner of Doug's in their firm called First Principles Capital, LLC.
Also tax efficient.
And the way, right, and the way these guys met was that Rob was involved in the insurance side of what's called COLI, corporate-owned life insurance. I prepared handouts. Did you print those out? Yourself. Oh, that's a different thing. Yeah, I think I left it in the Sloan building. So okay. I'm going to turn things over to
that's
Doug
fine.
And get the handout.
We have slides. Okay, so I'm going to just give a few rules of the game. So when I teach a class, the first rule of the game, as a person who was in your shoes many years ago, is, and it was extremely frustrated, was I encourage the minute you have a question to ask the question. Because I always remember that I would be sitting in the class and have a question and the professor would tell me, you can't answer the question until the end, which always I took as meaning this professor probably is afraid that I'm going to ask a question that he doesn't know. So he's just going to blow me off and hope that I forget. So the reality is I welcome the challenge of all questions. The second thing that I do when I teach classes, and I leave an element of doubt and uncertainty, is there is a positive probability that I will say something in this class intentionally incorrect. Okay? Not 100% chance. There's a positive probability that I'm going to do that. So as a result, you need to pay attention. Because as a student with social responsibility to your fellow classmates, somebody needs to identify if I've actually said something wrong. So A, you need to understand what I'm saying. B, you need to pay attention. C, you need to then hopefully understand what I'm saying and then decide whether it's worthy of asking me whether I'm saying something stupid and incorrect. Now, the reason I do that is not just to have fun with you. The reason I do that is because I think that's the most valuable thing I can teach you today. Because all of you people are wonderfully smart. And I have seen numerous instances where wonderfully smart people let senior people who are presumed experts like me say incredibly stupid things and go off and do incredibly stupid things, not being challenged by the person who's less senior, and he's fearful of speaking up. So I want to start the process of experts can do incredibly stupid things. Many of those experts give you an air of expertise to push back people who actually see through what's going on and can give you incredible and add incredible value. So that's the main reason I do it. You need to understand that just being smart is necessary, but it's not sufficient to helping a business be successful. And it's my role in running my company. I always am cognizant of the fact that I'm bringing in smart people, but I need to make those people feel comfortable to be able to come and challenge me, because sometimes they'll be wrong, sometimes I'll be wrong. And the only way that I can learn is when people challenge the conventional thinking. Now, when Professor Bodie asked me to teach this class, he was focusing on the experience with Gen Re. But before I get to the Gen Re experience, what I think is incredibly valuable is to give you a very quick tour through the derivatives industry, because there's value to understanding history. A lot of people just throw history out the window, and we were just having this conversation about history. I have a philosophy about history, specifically in the financial service industry, which says history repeats itself when all those people who experienced history are history. So basically what happens is, especially in the financial service industry, basically guys come in, they do these transactions, they make incredible mistakes, they make lots of money in the short run, they blow up and they lose the money. What do? You fire them all. So all those people who learned about their mistakes flushed. And you bring in a new set of guys who never learned from those experiences, have no clue about the failures, and they go off and repeat the same stupid things that they do. Now, the caveat to that is we were thinking that maybe what the financial industry should do is take some of those people who failed and put them as regulators. And that might have solved some of those problems, but we won't know. So what I want to do, since I unfortunately have been in this industry too long, and specifically the derivative industry, is I want to give you a very brief overview of what happened in the derivatives business. How did we get? You guys know where we are. The question is, how did we get here? And it's very interesting. I can tell you that I would not have been in the derivative business if the derivative business stayed the way it was when I first encountered it. The derivative business in the early 80s was, the best way I can describe it, was matchmaking. Basically, you had people who had very nice offices on high floors of investment banking buildings who had relationships. And a client would call up and say, the Kingdom of Sweden would call up and say, I would like to do a 5-year interest rate swap. And the corporate finance banker would say, okay, that's very good. We'll get back to you. Because in other words, what that meant is, if you know about investment banking, I really don't like to take any risk. My goal is to basically be a concierge, basically collect free fees and take no risk. So what that meant is he would then go to all of his other friends in other offices with nice views of the Hudson and say, can you find me somebody who wants to take exactly the other side? No mismatches whatsoever. Can you find somebody who will be willing to offset the Kingdom of Sweden's trade perfectly matched? If Kingdom of Sweden wants a 5-year swap, we need to find a customer that's going to do it exactly a 5-year swap. Well, people like me weren't going to get involved in that business. But one smart guy on the investment banking floor said, I was on the elevator the other day and I passed through this the bowels of the firm, where there's a bunch of guys that will trade anything. So maybe what we should do is see if we could get those guys down there to do these trades. Why wait? Kingdom of Sweden wants to come and do a deal. Why do I need to wait to find if IBM wants to perfectly pair? There's a bunch of guys every day, they throw, a side of beef down there, and those guys go off and scream and yell and do trades. They're in the basement. But look, this is great. The firm, I don't know if it's great for the firm, but certainly I can get my trade done. I'll promise those guys on the trading floor that we'll work to find somebody to eventually offset that trade, but there's no guarantees. But still, now I get to print a lot more trades. I don't have to find a match, which takes a lot of time. A typical swap transaction in the early 80s could take 2 years before you could find somebody. At that time, guy figures he doesn't want to do it. So this incredibly smart guy in the corporate finance department on the 43rd floor said, let's go downstairs to the trading floor and see if we can convince these guys to take this risk. I can get my fee and do more volume. Well, what was the consequence of that? The consequence of that was, all of a sudden, you didn't need just guys who had relationships. You needed people who knew how to manage risk. You needed people who could take risk, recognizing, and it took a while, of course, that, you know, those guys on the corporate finance floor that said, yeah, they're going to work to lay off these risk positions? Probably after the first 18 months that guy didn't come down and show you the other side of your trade, you kind of figured out, maybe I'm going to be holding these risks for a bit longer than that guy had told me. And why? Because the guy had no incentive. You paid him this fee for bringing that deal. He got it up front. Out of sight, out of mind. That was where we started the love-hate relationship between trading and corporate finance. And every time I saw one of those investment bankers come down to my trading desk, I knew there was going to be a hole in my pocket. That I could assure you. And there were many times where there would be, you know, arguments, vehement arguments on the trading floor, which the corporate finance person would never have been experienced, because most of the people are very polite that they're dealing with on the high floors as the concierge. And down on the trading floor, when you're putting at risk the shareholders' capital, there's pricing reality, not just purely satisfying the objectives of the client. So, because of that, you suddenly needed this influx of quantitative people, because you needed people to actually price these transactions, because you don't need to really price anything when you're matchmaking. As long as this guy agrees, you put them together, life goes on. But when you're now not have any certainty as to whether you're going to find the other side, how long it's going to take, now all of a sudden you need to figure out a strategy for how am I going to manage that risk. And so that began the process of bringing in quantitative people. That's how I got my first job. My first job was as the quantitative guy to the JP Morgan derivatives desk, because they said all these traders were used to just picking up the phone and trading stuff. They needed somebody that actually knew how to price the stuff and could advise them, well, what am I going to do to mitigate this risk? These are derivatives, remember. So theoretically, there's a portfolio that you can put together, either dynamically or statically, that will replicate the derivative contract, and then the essence is to price it properly, and either for the dynamic aspects of it or for the static aspects of it. And we're going to get into a lot of the other external factors that need to be dealt with when we deal with Gen Rate. So that whole process of bringing in the quantitative people actually corresponded to another significant event that took place in that late 80 period, the power of the PC and the computer technology that was being brought in to the power of the trader sitting on the desk. We had good computing power, but it wasn't accessible to the guy sitting on the trading floor. You know, the guy who was programming COBOL or Fortran for the bank's systems, that wasn't as, give the guy who's sitting on the desk, you give him a spreadsheet, and suddenly that opened up the world to innovation. Now the guy could try out developing new kinds of products and ideas. It became much more, you empowered a lot more people to be able to do transactions and structure transactions and price transactions. So that combination of change of the model from a corporate finance model to one which was trading, risk management, and risk warehousing, plus the combination of analytics and computer technology, that allowed this industry to really grow. And as Mr. Buffett will say, beware of the Greeks, of the geeks wielding Greeks, is how this industry started. You had the evolution of people with quantitative backgrounds. And, you know, everybody knew who those people were. They looked a little different than the investment bankers. And you had a bunch of guys walking around with their computer models and analytics. And they were the dangerous, so-called, according to Mr. Buffett, dangerous geeks bearing Greeks. Now,
and they typically had their shirt.
I can tell you a funny story about this, okay? Now, I was, again, coming back to my example about, you know, challenging the expert. Well, I was the quantitative guy, and I started thinking, this is really stupid. Why am I helping this guy doing all the work, pricing all these things, building the computer models? Then the guy doesn't really understand how to use the model and how to hedge. What do I need that guy for? What value is he adding? And why is that guy getting paid more than me? This makes no sense. So one day I had one of the traders who I built one of the first interest rate option, long-dated interest rate option pricing models for us. Swap options, they were called in the beginning. And I was the guy who built the model to price it. And the guy calls up complaining about the model. It's not working, I'm losing money. And I'm telling him, it's not the model, guy. It's the things that you're doing and the risks you're taking. It's not the model. So the guy's coming and constantly complaining. So what do? It's a Friday. I was generous. I was a nice guy. I go down to the trading floor. I said, you don't like the model? here's what I'm going to do. I go onto his computer. I erase the executable. I said, I'm being generous to you. You have the whole weekend to go and rebuild the model so that when you come back on Monday, you'll be able to run your book and hedge it better. Since you don't like this model, build your own. By the time I got back up the elevator, my phone was ringing off the hook. Please give me the model. I can assure you that I stopped that bad behavior immediately. That was my way of dealing with proper incentives. Okay, now, as a person who is in the derivative business from the days it started being a real trading business, I can tell you, much like Mr. Buffett, these things are dangerous. This is a classic example of the dangers of derivatives. They seem simple. It gives you the ability to have very complex, highly leveraged transactions that seem so simple and elegant and easy that anybody can do it. Well, it's one of those things that only a professional driver should be doing. And I give you this funny story about this man. I'm not sure anybody knows this man, but this man, Robert Citron, was the treasurer of Orange County. And he went about doing a lot of structured notes. And what is a structured note? A structured note is a note issued by, many times he would use one of the government agencies to issue this stuff. And it had all these highly leveraged, complex, embedded derivatives which had substantial leverage in the contract. And he had one particular trade that was betting on the relative shape of the yield curves between Swiss interest rates and dollar interest rates. And in the summer of 1993, I talked to Mr. Citron. And I said, you know, Mr. Citron, I'm very worried about your positions because in addition to having high leverage in the note itself, because he was doing this with government entities, he actually was able to then borrow against these structured notes that had tremendous leverage in it. He was able to actually leverage it again by going and taking these government agency notes with embedded derivatives and going to repo desks, financing desks, and borrow again to just get the leverage, which might have been in the note itself 10 times, up to 200 times. So I said to Mr. Citron, I said, Mr. Citron, looking at the shape of the yield curve, this is 1993. You have a position where if U.S. dollar interest rates start going up a lot according to what the forward curves are saying, and Swiss franc interest rates don't go up as much as the dollar interest rates, and that's what the forward curves are saying, given the amount of leverage you have in your notes and given the amount of leverage you have with your repo desks, you could have a serious problem. And his response to me was, son, you don't understand. I am an arbitrageur. And so I say to him, well, could you help me understand what an arbitrageur is? He says, you're looking at all these forward curves and all these market implied value. What an arbitrageur does is he looks at his bank account and sees how much money is coming into his bank account every month. So I'm saying, so what this guy is telling me is he's addicted to this positive carry, which has absolutely nothing to do with what's going to happen in the future. He's just saying it's an arbitrage if I have positive carry on my position. Well, that arbitrage turned out to be such a disaster that, as I like to say to my wife, honey, I shrunk the assets. Okay? Well, this arbitrageur shrunk the assets of Orange County to such a level where the man almost led to one of the most significant bankruptcies of a municipality in the U.S. So, derivatives are dangerous. They have to be done by people who understand, because they have the leverage, they only should be done by people who understand them, number one. And that's as a person who's done derivatives his entire life. Number two, I can tell you that you can make a lot of money with derivatives. There are significant mispricings that take place in the derivative market. But you need to understand what the sources of that mispricing are. It is very rare in my entire lifetime. They exist, and I'm not going to tell you what they are because I have them on right now. But there are completely riskless arbitrage opportunities there. Most of the opportunities, however, are a result of the marginal player in the market pricing a risk factor other than just the replicating derivative risk. I mean, we all know if you try to create a futures price, we know how to replicate it with the bond and borrowing. The reason those prices can materially differ from those arbitrage boundaries is not because some guy is making a mistake on the pricing of the arbitrage boundaries. The reason that exists is because the person who's the marginal pricer of that contract has an external factor, tax, accounting, regulatory factors, liquidity issues, liquidity pricing, that causes him to price that, including those parameters, and you need to assess whether you have a similar risk to those parameters. If you have the same risk to those parameters, that the margin, it's not an arbitrage. You're just going to get screwed. So when you do an evaluation and you see it's too good to be true, most of the time it is too good to be true, and you need to assess it's not a riskless arbitrage. It's all about the marginal pricing of factors that don't get incorporated in the typical arbitrage boundary conditions of looking at a derivative. Okay. Now, I'm going to give you I will give you a cute trade, just to give you a flavor for how you make money in derivatives. This was one of my best trades I've ever done. So in 22 years, I still talk about this trade. And unfortunately, there's probably a lot of poor people that talk about this trade too. And let me give you...
We're on the other side of the trade.
Absolutely. Let me give you... It's a very clever idea. Okay. Here's the way it works. Typically, at the end of a year in the financing markets, the rate to borrow across a year end typically tends to be higher because people tend to be try to deal with borrowings across the year end. They tend to want to lend. They tend to want to not lend across the year end. They try to want to keep their cash in their books at year end. And then there's a lot of demand for people who want to borrow across year end. So right at that DES-31, that last week of the year, there tends to be a spike in the interest rate over and above just what you would expect from the baseline rate of, of what you would think the baseline level of rate is. There's a premium for funds to cross the year end, and that gets priced as an incremental spread in the borrowing rate. Okay, so I had this idea. I said, there's always this pricing phenomena that goes on with respect to year-end liquidity. But you know what? We're coming to a rather weird time. We're coming to Y2K. And the market is basically pricing that year-end premium as if it's a typical year-end. Just the same amount of basis points, the interest rate spread. It's roughly the same as it was for all the other year-ends. But I said, this year-end, I don't know whether it's really going to be different, but psychologically, people are going to start to think that there could be something different about year-end, this year-end in 2000. And all of a sudden, people are going to be much more concerned about lending over into the Y2K because there might be a liquidity problem, and they may need that money, and they won't be able to get it back because the world is going to come to an end and all the computers don't work. Okay. That's the theory. Now, I'll tell you what the reality of it was going through my mind. But I felt, in theory, this is a wonderful thing. And if I start doing a trade, that theory will become reality, and the fear will start to get going. So I said, what I am going to do is I am, in the futures market, I am going to lock up that rate across the year end. I am going to borrow like crazy right now across the year end at a very low premium. So I'm going to get all this lovely money in before the 2000 and actually give it back to people beyond 2000. Now, to do that trade, you wind up realizing, well, this is like in 99, so early 99, I'd have a lot of interest rate risk. So I need to mitigate that. And I have yield curve risk, so I got to, I may be right, but I could still lose because rates could go up, rates could go down. So I need to do something to mitigate the fact that levels of rates could move. So that's why it turns out to be what's called a butterfly. Because what I did was I was borrowing money across the year end, and then I did lending transactions before and after to basically mitigate my exposure to interest rates moving and the shape of the yield curve moving. So that's why it's called the Millennium Fly. So I started doing this trade on the futures exchanges in small size, a couple of billion. And then I started doing more. And I did more, and I did more. And nobody figured out what was going on. And so I was able to get, in the US, I did it all over the world. I did about 100 billion of this trade in the United States. And then when I couldn't do it in the United States, I went to the UK, I went to Japan. And you know what? I didn't really believe there was going to be a Y2K problem. And I actually thought that what would happen is the Fed would probably pour liquidity into the system. But that doesn't matter in making money. The reality is not the essence of making money. It's the perception. And once everybody figured out, oh my God, we just lent this guy money across the year end, it just exploded. Everybody panicked. And actually, the funny thing is, because everybody panicked, you don't know the feedback effects, but because everybody panicked, it may have actually influenced policy that the Fed ultimately undertook to actually facilitate this, because they saw the implied market pricing for what was going on across that year end suddenly blew up like 5%, 6% all of a sudden. Of course, I wasn't going to wait to see whether my nice little theory was ever going to become a reality. I just took off the trade and gave it to everybody else. Of course, what happened is I made my money, and all these other guys wound up losing the money who I gave the trade to, and then losing the money because the Fed then, if you wound up holding this trade to maturity, you actually didn't make any money because the Fed just poured liquidity into the system. The year-end turn was actually less than it ever had been in the history of the market. Yet I wound up making 500 basis points on several $100 billion of three-month borrowing transactions. So you can make a lot of money, and not all of it is necessarily predicated on something that is actually going to be realized. A lot of it is going to be the perception that occurs in advance of the realization. Okay, now we're not disagreeing with Mr. Buffett. Derivatives are dangerous. You can make a lot of money because there are mispricings in the market. Okay, now let's fast forward into Gen Re. Now we've got the framework. Gen Re was a very interesting transaction. Mr. Buffett did not buy Gen Re to get Gen Re securities, the derivative deal. You can be assured of that. He bought this because he wanted to get a distribution capability for his reinsurance. And Gen Re was one of the largest U.S. property and casualty reinsurance companies. And he felt that he had the capital, he had the pricing capabilities, he wanted the liquidity associated with this, and he wanted the distribution capabilities that were going to come with Gen Re. And he felt that they had reasonable underwriting capabilities and distribution. That might be the mistake, but that's what he thought he was getting. Okay? So, unfortunately, there were some externalities that came along with that package. One of them was Gen Re, which was called Gen Re Financial Products and then renamed Gen Re Securities. So I'm going to use Gen Re Securities, GRS. But this is very interesting. Okay? He did nothing at the acquisition in 1998 with respect to the derivatives entity. But interestingly, he took immediate action because he was going to take over Gen Re. He was going to let them distribute and underwrite the insurance parts, but the float and the investment portfolio was all going to be managed by Warren. He was going to make all decisions. And as part of that, very interestingly, he made them, when he felt the merger was certain, he made them liquidate, which this is telling, he made them liquidate all of their common stock holdings. And even more interesting, because they had a low basis in this position, they had to pay almost $1 billion in tax. Now that is counter to everything you understand about Warren Buffett. Paying taxes, accelerating the payment of taxes, think about how much return the man can make on $1 billion of float. So he really came and said, as he says, on the next slide, and then we need to think about this quote, this clean sweep approach reflects a basic principle that Charlie and I employ in business and investing. We don't back into decisions. So he saw that equity portfolio. I don't like it. I want it out. Pay the taxes. I'm never going to be driven purely by tax. I'm going to be driven by economics. I don't want to have these guys managing equities. I don't even want them to have the equity exposure until I close and take it over. I want them to dump it. But interestingly, what happened here? This is the derivative book of Gen Re, which he acquired in '98. So this is what he assumed. Okay, these are principal amounts of contracts. Is that a clean sweep approach to something that you don't like? I had 515 billion of interest rate swaps. I went into 652 billion. I had 88 billion of options written. I went to 122. I had 91 billion of financial futures. Now I'm at 151. I went to 103. This doesn't look like a business that, I'll admit, it's very hard to sell and close down a derivative business. But it's really hard to close down and sell a derivative business if you immediately take it over and put it in wind down. So what does this picture tell me? There's two possible explanations, and we can't actually conclude which one is possible. What it could possibly tell you is he didn't want to close it down. That's a possibility. He continued to operate it, let it go, and he didn't really want to close it down, and something happened that led him to say, I need to close it down. The other possibility, which is also as much a viable possibility, is he said, you know what? I want to get rid of this thing. But if I shut it down, who's going to buy an entity that's in wind down mode? It doesn't work. I need to show that we're going to continue to run it. It's an ongoing business because I want people to come in and buy an ongoing business. So those are really the only two possibilities. If anybody else has any other possibilities that they can offer, I welcome them. But from my perspective, there's only two. Either he decided this was not, because I told you, clean sweep approach. If you don't like the derivatives, clean sweep approach would mean put it in wind down immediately. We didn't do that. Or I want to sell it, so I can't put it into wind down. I need to try to give the illusion so I can attract buyers that this is really a viable business. It just doesn't fit with my business model. Okay? Does anyone have a view on that? Or supporters of Mr. Buffett, anyone have a view? I hear no views. I'm disappointed. Very disappointed.
What if he was actually buying more securities in order to mitigate the risk and...
This is notional. There are no securities here. This is all derivatives.
Well, no. I mean...
He had securities. I took those off.
So he's buying more derivatives in order to mitigate the risk by maybe possibly buying...
So you're saying... So what you're saying is this all reflects... That's a good answer. This all reflects dynamic rebalancings of his book that couldn't be replicated statically, that he had all of these options and that he needed to add more options purchased and more options written to dynamically manage what he took over in 1998. And all this reflects is the rebalancing activity of a static portfolio. Okay. Well, the answer, it's a good thought. The answer is that's not true. But it's a good thought. Because I know the reality that they were actually running the business and they were continuing to do more transactions, and those transactions were not related to wind down. Because you can see when he makes the decision to wind down that if there was all this dynamic need, that you see it should have been much more stable even when he decided to put it in wind down. But when he decided to put it in wind down, these numbers started to go down. So your hypothesis is a good one. But the reality is, if I show you the 01, 02, and the subsequent ones, you're going to see that these numbers come down dramatically because he was aggressively trying to unload those trades. And if he really wanted to get out of the ones that are so complex that they require all this rebalancing, those are the ones you pick up the phone and get rid of first and see if you can negotiate an exit. So the reality is, that's a good point, but the actual reality as a party in the know is that wasn't the reality. Okay? Now, here is, so we have, that's why you notice I was very careful about love, because I had the question mark about love. We don't know whether he loved it. Maybe he gave the illusion of love to try to sell it. Or maybe he did love it and then he learned to hate it. But by the time we get to 2002, which is after we had worked on the transaction to try to purchase the entity and couldn't come to an agreement, which we'll go through, and Mr. Buffett actually lays out every argument I made as to why we couldn't come to a deal. And the 2002 literally looked like the letters that we said and the communications we had around the issues affecting the purchase price. And it was all laid out in 2002. Wonderful, wonderful document. Okay? But he said, we purchased Gen Re. It came with a Gen Re Securities derivatives deal that Charlie and I didn't want, judging it to be dangerous. We failed in our attempts to sell it, however, and we're now terminating it. Out the door. Okay? Not sure it was a clean sweep approach, but he did terminate it. Now, Now let's try to understand these are the factors. And it's going to be interesting. You need to understand these factors because these factors, I'm going to make arguments later, are the principal factors that are driving the economic value proposition he has in his derivative contracts today. And I can prove that. Okay. The main issues affecting this book are counterparty credit risk, contingent liquidity risk, residual liabilities from complex transactions, marking to myth, and the associated compensation temptations that occur. Now, I want to go through each and every one of those in excruciating detail. Okay, you roll forward to now, and it's kind of amazing that you are able to see Mr. Buffett talk about doing a derivative transaction in 2008 that doesn't involve collateral agreement. That is not as unusual in the early 90s, and I'll explain to you why. The dominant participants in the derivative industry in the early 90s were highly rated entities. And why was that? They were going to use their counterparty rating advantage to basically win business with corporations. Most of the users of the derivatives were corporations who were issuing debt. Okay? So you issued a debt and you wanted to convert the interest rate risk of the debt into a different form. You might have issued fixed rate debt and you wanted to really have floating rate debt, so you used an interest rate swap. The problem with corporate issuers is they are corporations. They're not financial service companies that have extensive amounts of liquidity, so they're not going to be willing to margin with you on gains and losses on the swap. They'd certainly be willing to margin with you if they were in a gain situation. They'd happily take your collateral, but there's no way they're ever going to give you cash or collateral. So to win that types of business, the banks wanted to use their high ratings to win business. And that's what the essence of the derivative business was, why it was done. And the reason it was done that way was to differentiate what was the over-the-counter derivatives business from the exchange-traded business. Because if you go to the exchange, which these corporate issuers wouldn't use, the exchanges were all margined business. So a corporation had no alternative. If they wanted to use the derivative market, they had to go to the banks, the over-the-counter entities, and they didn't want to take credit exposure to poorly rated entities because they were at least willing to give you symmetry. They weren't taking collateral, you weren't giving them collateral, and they weren't going to give you collateral. So it was all symmetric. We just had an uncollateralized contract. Now there were complexities where you could have triggers, and we'll discuss that later. But in general, that was the essence of the business. It was an issuer-driven business. It was all those corporates wanted to deal with credit-worthy party. You could leverage your rating. And I remember being involved at J.P. Morgan with these gut-wrenching discussions about whether we should do collateralized business and whether that would damage our franchise because we were so highly rated, and if we started to do that, it would open up a Pandora's box, and we'd lose our edge because we had the rating advantage over many other parties, so we were concerned about going down this route of collateralizing transactions. Eventually, the battle was lost, and everybody decided to go to collateralized transactions. But the interesting aspect of that is that kind of occurred because there then began to grow a whole industry of users of derivatives that no longer were just pure corporations using derivatives. You had investors using derivatives. You had all kinds of entities using derivatives where they were willing to engage in collateralized transactions. So the growth of what was happening is the growth of the business was really being stifled by that credit limitation of this business. So people just capitulated and said, let's just grow the business and go with collateralized contracts. Now, the issue of counterparty credit is a very complex issue because it's really related to, when you're the counterparty, if I'm J.P. Morgan and I'm doing a transaction with Berkshire, I've got to look at two issues. I've got to look at what is going to happen to the mark-to-market value of that contract related to the underlying variable. I do an equity index trade or an interest rate trade. I've got to think about how is that underlying variable that's driving the change in value in my derivative contract causing that contract to change its value. Now, as you know, a lot of these derivative contracts, their signs can change. Suddenly you're in a gain position, you're in a loss position, their signs can change, the magnitude can be very volatile. But from a counterparty credit risk perspective, what you're worried about is what is the probabilities associated with the contract being a win for the dealer and the counterparty defaults. So that's the risk that you're modeling. You're always modeling the risk that the contract is in a gain position to you, a lose position for the client, and the client goes down. And the biggest risk that you always had to be cognizant of is this thing called wrong way risk. And I'm going to give you an example, the worst case example of wrong way risk. The worst case example of wrong way risk that I've seen in my career by a dopey derivatives dealer was doing total rate of return swaps on government bonds with the government. That government. Okay? So you know when that government's bonds are going out of business and all of a sudden you are in the win situation and that government is in the lose, the government is out of business. And I can tell you right now that, you go back to 1994 with Bob Rubin standing there and talking about bailing out Mexico. And I can tell you that there were a ton of Mexican Tesa Bono total rate of return swaps done with financial derivative dealers that influenced that decision because there were a bunch of total rate of return swaps on Mexican government bonds done with the government of Mexico, which was completely wrong way risk and completely mispriced for that. So you always need to be cognizant of that. You always need to think about, is the contract that I'm engaging in with this party based on the business this party is in? Is there a risk that the contract is going to be in a lose position for that customer and the guy's going to be in default? Which I want you to remember as we discuss the value proposition associated with Mr. Buffett writing puts. Is there going to be a wrong way risk element of writing uncollateralized puts with Mr. Buffett? Okay, now here's one. I will not answer this. I am expecting you to answer this. And I'll give you 5 minutes. And I'm going to leave without answering this because, as I told you, maybe I'm not going to say something wrong. Maybe I am. But this one, I want you to read this. I'll read it with you. And you tell me if there's anything that makes you concerned about the methodology that's being used here. So, and this is the actual methodology, and I know the details of that methodology because that was a critical component in the buyer evaluation. It says GRS evaluates and records a fair value adjustment to recognize counterparty credit exposure and future costs associated with administering each contract. The expected credit exposure for each trade is initially established on the trade date and is determined through the use of a proprietary credit exposure model that is based on historical default probabilities, market volatilities, and if applicable, the legal right of set-off. You can ignore that. That's a term related to netting benefits of gain and loss trades with the counterparty. These exposures are continually monitored and adjusted due to changes in the credit quality of the counterparty, changes in interest rates and currency rates, or changes in other factors affecting credit exposure. What catches your eye in this long-winded explanation, but really doesn't tell you a whole lot about what they're doing, but seems nice, and every derivative dealer puts one of these disclosures.
Is it the phrase where it says proprietary credit exposure model, the fact that it's proprietary and you don't know how it is made?
Well, that's an issue, but I can't say whether it's right or wrong because it's proprietary. So we don't know. That is possible a problem, but we can't definitively say. There's one thing in this thing that should raise your tentacles.
Someone over there had their hand up.
Yeah, I was just thinking about using the historical.
Correct. Okay, isn't it interesting? This is very interesting, right? And it's an interesting juxtaposition. You're using historical default probabilities, but you're going to use market volatilities. Well, why isn't the word market next to these default probabilities? Because remember when we're engaged in this transaction, we're in 2000, 2001, early 2001. Looking at historical default probabilities, this was the heyday. There were no defaults at this time, at this particular. So looking in the rearview mirror, there were no curves looking in the rearview mirror. It all looked great in the rearview mirror. But unfortunately, what happened is we had September 11th of 2001. And that is a big problem because historical default probabilities and the use of historical default probabilities would lead to the pricing of loans that aren't consistent with the market price of loans at that time. So all of a sudden you had a situation where market credit spreads widened substantially and were substantially wider than what would have been the spread implied by looking in the rearview mirror at historical defaults. So effectively, when you buy a derivative book that has counterparty credit exposure because there's no collateral, you're buying a loan book. And when you buy a loan book, you need to buy the loan book at the market price, not at the price consistent with historical default probabilities. You know, that might be great if the market probabilities the market implied probabilities are lower than that. But at that point in time, it was asymmetric. The market implied probabilities were way higher than historic, and therefore it made no economic sense. Why would I take investor capital and buy an off-market loan book? That makes absolutely no sense. So becomes a major issue when you're buying a portfolio. I mean, if I had capital to deploy, I might as well just go into the market at that point in time and buy a loan book at the market. The return on my shareholder capital is going to be substantially better. Why buy a loan book based upon historical default probabilities? But I am going to come back to this. I want you to think about, we're going to talk about historical default probabilities when we think about what could be going on with Buffett's uncollateralized contracts. The other thing I want to point out is this, another interesting thing, not a problem per se, but the future costs associated with administering each contract. That we're going to come back to when we talk about marking to myth. But remember that one. And I'm going to tell you how many years of future costs were built into the contract versus the reality of what actually happened to wind down this portfolio. Okay, next, this is another huge one, and another one which is you need to think about as well. Okay, now going one more point about the credit is, think about this. I take over this big loan book. I'm not in the business. I'm trying to run a derivatives business. I'm not trying to run a loan business. So you know what's going to happen if I buy that business? I'm going to go buy this business. It's got all this credit exposure. You know what I'm going to do? I'm going to go in the market and try to hedge all that credit exposure. Well, where am I going to get the money? If I didn't price the book of all these loans that I just talked at the market and I go out to hedge that exposure, I've just locked in a big loss. So you can't buy the book with not consistent with the market prices, because if I don't want to just take massive amounts of credit exposure and tie up substantial amounts of capital for credit, I need to hedge it. Because I want to use my capital to do new business, not to hold an old book of loans. So if I have to go out and hedge that, I'm going to take big losses and lock in losses with mark-to-market losses of fairly substantial size. This is another interesting one. Okay, the issue here becomes, let's think about what goes on when you do a trade with a party that has no collateral agreement, and then you lay it off with the dealers. Okay, so I entered into a trade with an issuer. I get no money from that guy when his trade is I've won and the counterparty, my corporate client, has lost. So when my corporate client loses and I win, I get no money from him. But of course, most of my hedging gets done in the dealer world or gets done with the futures exchanges, which require daily collateral. Okay? So now what do? I won on the trade with my corporate client. He gives me no money. I've got to now deliver money on a futures contract that's getting margined every day, or I've got a dealer derivative contract where the dealer calls me up, Morgan Stanley, okay, you owe me $100 million, give me the money. Well, if you have symmetry in your contracts where I get the money from the losing party and I give it to the winning party and I'm just in the middle, that's all fine. But when you have this type of asymmetry where you're not getting money from the one party, but you need to give it to the other, where does that money come from? Where does that money come from? Does anyone have an idea? Comes from the corporation that's the dealer, okay? Now, where do I get that money? Let me tell you something. There is no secured financing market for derivative receivables. There is no repo market for derivatives. So the only way I get the money is I got to go in the market and borrow it. Which, what does that mean? That means I am exposed to the debt spreads, unsecured debt spreads, of where I can issue debt in the market. Well, that's going to be a problem too, because who do you think has the lowest cost of debt financing, Mr. Buffett or Doug Dachille? Mr. Buffett, right? AAA. So now all of a sudden you're going to transfer a contingent liquidity risk from a person who has the lowest cost of funding these liquidity mismatches, and you're going to transfer it to a guy who could be borrowing at spreads of 300 basis points more than Mr. Buffett. So what does that mean? My bid for the business with these contingent liquidity risks has to be different than his hold it, and you fund it. Because if I have to fund it and take this exposure, it's going to be much more costly, and I need to price that in. Okay, now, this is another one. These things are complicated, and you made the point already that you could have to do dynamic stuff. Okay? Well, dynamic stuff becomes very expensive when you're not doing more business. All of a sudden, you're just sitting there, you have a bunch of traders that are sitting there doing no trades, so there's no natural offsets to the things that you may have to have done on a day to offset that. So all of a sudden, you put this thing in runoff, and you're just babysitting very hard to actually get the efficiency of and minimize transaction costs. Transaction costs go way up, and most of these complex models for these complex derivatives do a horrendous job of factoring in the costs of transaction costs. They're nowhere.
Isn't that still cheaper, though, than taking $1 billion in taxes when you just liquidate your securities?
Oh, these things? But you see, the thing is, that's unknown. This is unknown. It's like, you know, that I know. I take my lump, I wrote a check for $1 billion, I'm done. The problem with this stuff, which gives Mr. Buffett all the worry, is I just don't know how much it's all going to add up in cost. He would prefer to write the check and be done with it. Clean sweep. This, when you just run it in runoff, there's still a lot of residual risk and uncertainty of what you're dealing with. You can never know, because it's all going to be driven by the future market movements as to how much rebound. If the market never moves, it's going to be costless. But if the market starts whizzing around up and down, you could be moving transactions. You have no economies of scale. You're a runoff business. It's very hard to do those transactions. Very difficult. Okay? The other things that you need to be concerned about is when you have to use a lot of cash securities. Because now, you know, if you're going to have, and I can give you a very interesting example to Professor Bodie's beloved asset class, okay? Hedging can require cash securities. And of course, cash securities, there can be, if you're a regulated entity, there can be economic costs associated with carrying on your balance sheet all of these securities, because you did a derivative. The beauty of derivatives is they're off your balance sheet. Now, all of a sudden, to hedge that derivative, you've had to consume balance sheet by buying cash securities and borrowing, because you know that a derivative can be replicated by some type of cash security and a borrowing transaction to replicate the leverage that's in the derivative. But if all of a sudden they change regulatory capital requirements or the cost of financing those securities changes, you're exposed, and it's not necessarily been priced in. Now, here's a beautiful example in the TIPS market, which could be viewed as an arbitrage or could be viewed as the pricing of regulatory capital costs. Okay, dealers, when probably in the 90s, when the TIPS started, 97, 96, 97, there was a rush to have corporations issue inflation-linked bonds. But of course, the corporations were not just issuing and paying inflation. They had no desire to be writing out a naked position in inflation, where if inflation goes up, their cost of funding goes up. So what do you think all these issuers did? What they did was they issued the inflation-linked bond where they were paying inflation. They went to derivative dealers to receive inflation and convert their inflation-linked bond into either a simple floating rate note linked to short-term interest rates or a fixed-rate bond. So they basically received inflation to pay the inflation out to the investor of the corporate bond, and then they paid a fixed rate. So they got rid of all the inflation exposure. Great. Well, now the dealer had the inflation exposure. Well, now they're paying inflation. So what are they going to do? So they look around. They call their corporate finance guy on 43. Do you think you can find anybody that's willing to write naked inflation to us? Click. Okay. Now what? So now what you've got to do is you've got to find something that's going to pay you inflation. Well, the only thing that you can find that's going to pay you inflation, TIPS. So what do? They go and buy a bunch of TIPS to hedge the exposure. Well, now they got billions of TIPS on their balance sheet that they're financing in government repo markets, but there's no profits, any extra profits coming from that. It's just a hedged, neutral profit trade now. And you've got a huge use of your balance sheet with no real return on regulatory capital. You're drawing regulatory capital, and somebody comes down and tells you, get rid of those goddamn TIPS. They're clogging up my ability to do profitable trades. So then what happens? Guy says, sitting on the trading desk, what am I going to do to get rid of these TIPS? What they do is they call hedge funds. And they say, I'd like to sell you a package. I'd like to sell you tips, and I'm going to sell you tips swapped. So what they're going to do is they're going to sell you the tips. So the hedge fund's going to buy the tips, and then the hedge fund is going to pay the inflation cash flows to the dealer. So now what the dealer has is a position where he's paying inflation to a corporate, he's receiving inflation from a hedge fund, he no longer has any balance sheet, and then the hedge fund gets a really good deal because the hedge fund gets a position where he now owns a government bond that can finance at, right now, 0. But the rate of return they leave on that package, on the asset side of the package, where I have the tips with this derivative package, I earn a rate of the LIBOR plus 100 basis points. So now I have a government bond position that generates me 200 basis points. Looks like riskless arbitrage, right? We talked about this. But it's not a riskless arbitrage. The reason it is because somebody's pricing in the regulatory capital costs, and a hedge fund doesn't have regulatory capital costs. So that guy is able to extract the regulatory capital costs associated with this big client deal that was done by derivative dealers and tying up balance sheet. So there's an example of where, and to be honest, that is today one of the greatest trades you can do. It's illiquid, but you know what? You can own a government bond at yield levels, at spread levels that are better than where Goldman Sachs right now is coming in 5-year government guaranteed paper. So which would you rather own? Government guaranteed paper of Goldman Sachs at LIBOR plus 0, or in government bonds, which I can actually repo. You can't repo those Goldman Sachs guaranteed bonds. But I can go to the Federal Reserve and earn close to 0 when I finance those tips and basically have 200 basis points. And if I don't have this external cost of regulatory capital, I don't care about my balance sheet.
Question about that.
Yes.
Back in October, when the yields opened up on
Yeah.
tips,
Yep.
just zoomed up,
Yep.
that was when the dealers were unloading tips?
No, that was hedge funds being forced to unload tips because you know what happened? That's how I come back to that risk. Those risks. It's never a free lunch. The risk was, and this happened big time in Japan on their JGB inflation-linked bonds. The dealers, when you enter into a financing transaction with the dealer basically says, okay, you have to put up some amount of cash, what's called the haircut. Okay, so typical government bond could be, you have $100 of bonds, they'll lend you 99, the haircut is 1. Sometimes 2. Well, all of a sudden, the financing desks on the street got very concerned about hedge fund risk exposure. And they said, you know what? We're not going to let you borrow $98 against your $100 of tips. We want to tell you, we're going to ask you to only lend you 90. Well, where does that guy come up with the other $8? The only way. So all of a sudden, the rules changed. You thought you could leverage these things 50 times. But all of a sudden, dealers came back to you and said, no, sorry, no more 50 times. Now you go to 10 times. Well, there's only one thing to do when the guy tells you you need to come up with more money. You sell. And those guys started selling like crazy, and that moved the market. In JGBs, that thing... And my neighbor in my office is the Bank of Japan. And they raised repo rates to haircuts of 15%. You should just look at the chart of the yield levels in a country like Japan. The yield on the tips, the real yield, is 3 times the yield of the nominal bond. Now, there's some reasons because there's no inflation floors, but it was predominantly because they raised haircuts on the financing of JGBIs, the inflation linkers, to 15 points. And, when I would see one of the guys in the men's room, I'd say 15%. Your primary dealers in Japan are charging 15%. It's killing your tips market. You better do something about it. And they would go, okay. And that's the reality of what was going on. Now, the other issue, the other things here is, and you see this one, is that the beauty of derivatives... No, good question. Go ahead.
Why did these guys trying to hedge against inflation, didn't they use inflation swaps instead of buying tips where they had to...
Right, there was no one to do the inflation. Because all you were doing by doing the inflation swap is pushing the problem of having someone just outright take inflation risk. And the problem is there's nobody who wants to just be short inflation, where they're just writing naked inflation. So everybody's always looking to... When in the derivative market, there's very few people that just want to have a macro bet at that particular time. Maybe there's guys now that are willing to punt, but structurally nobody wanted to take a risk of just being outright paying inflation because it's a wrong way risk. There's so many, why would you want to have that type of risk exposure, and were you getting paid a premium? And the premium was basically you didn't have to take that exposure, and they baked in that premium by taking over their position on the bonds and then paying them inflation. So I actually got compensated without having to take naked inflation risk. So it was a better trade to do it that way. Now, the other thing we talked about is the beauty of mark-to-market. Well, derivative contracts get mark-to-market, but they tend to get mark-to-market on the asset side. So you do a trade, 30-year trade, you get to present value all the future profitability for 30 years, boom, it goes right into your P&L. Okay. But you know what? I got a staff of 20 guys. I got to do resets and confirms. Where's the PV of that? Where's the 30-year present value of my operating expenses in the P&L of the derivatives business? And I harp back to that little thing where we talked about historical default probabilities. There they said they built in some operational costs. They built operational costs of 1 or 2 years typically. Yet you took them 5 years to actually unwind the book. So clearly most of these marking to myth issues with respect to future costs, they underestimate the costs of trying to wind down these entities, and there's insufficient operational reserves to deal with the ongoing expense of having all the people do resets, call clients, confirms, mark-to-markets, a lot of operations. Okay. Now, compensation is evil. This is an evil one. I'll go through this one quickly. This is crazy, and you'll see the insanity of what derivatives can do. Okay? Guys, at the end of this subprime woe scenario, everybody, all the dealers realize these bonds are garbage. Okay? So we all know this is garbage. But you know what? I want to continue to produce it because I'm making a lot of money, but I can't sell them anymore at the spreads that they're trading. So what should I do? So, and I can't make any money. There's no more spread tightening that's going to take place in these bonds. I originate them, but I wind up holding most of them. And I think they're really risky, and I want to show a gain, but now the spreads are so tight I can't do anything about it. So what they did, this is genius. What they did was they went to bond insurers. Said, bond insurer, I have a AAA bond, but I really want you to insure the bond. So can you reinsure this AAA bond and make it really AAA? Because we're not sure these are AAA. We want guarantees AAA. So I went to all of these bond insurers, Ambac, Moody's. I didn't. The dealers went to them, and they got additional bond insurance to make them super AAA. Now, where do you mark a super AAA bond? Super AAA is not just AAA. So all of a sudden, there's no market for these super AAA bonds. There's a guy, he created the bond, he owns the bond, now he went and got an insurance. He suddenly marks any of the remaining spread that existed on that bond after he paid the insurance premium. He said, that's all profit, because there's no risk anymore to those bonds. I have a riskless bond now. So, I bought a bond that had 20 basis points of spread. I paid 10 basis points to the insurer. I now have 10 basis points left. Let's put into the P&L right now the value of 10 basis points running for the next 5 years right into my P&L. Now, when you do that, now you take a bond that used to be 100 on your books, and now it's 101. $1. I made $1, and somebody compensates me on the dollar. Well, of course, once you value the bond at that price, there is no buyer for that bond. It is done because there's no more way to make money on it. You've extracted every drop of juice from the lemon. You've taken a AAA bond, you reinsured it, maybe you reinsured three times, and in the attempt to squeeze all of the P&L out of that position and mark it up so you can get paid cash compensation today. That's where we have the AIG scenario. That is what AIG did. And they decided, and you see, the funny thing is, the minute that guy did that trade, he's high-fiving his neighbor. Awesome. But what he forgot to realize is every dealer in the street was doing that trade with those same guys. So yeah, you thought you had a great trade and you got reinsured, but the problem is that insurer was doing that same stupid trade with everybody, and they were providing you with no real protection. And that's how we lost our bond insurers in the United States. That's how we lost AIG in the United States. Those guys did that to the tune of $1 trillion. Okay, so, of course, the consequences are you can never sell a business like that. It's unsaleable if you've got these types of issues embedded. Now, I think this is, I won't read this, but this is a philosophy. I believe that he applies to insurance. The question you need to ask yourself is, shouldn't many of these principles apply to derivatives transactions? Shouldn't these apply to investment decisions that you make? So every aspect of these are great principles. I endorse you reading them carefully, and you should think about them. But it should not just apply to insurance underwriting. It should apply to his investment decisions. It should apply to his insurance decisions. It should apply to his derivatives activity. He needs to be cognizant of staying within your circle of competence. That's one of the most important principles. Making sure you don't have aggregation of risks from seemingly unrelated events that suddenly create a correlation in your business. And this one is very interesting. Avoid doing business with bad people. And we'll come back to this. Okay. Now, we all have already talked about this. Derivatives are dangerous. I agree. There's no such thing as a bad derivative, just bad derivative pricing. Definitely. Now the question is, once he saw how much money he might have been losing by being a dealer, and all the things I just outlined for you as how you lose money being a dealer, I think the light bulb went off in his head. Wait a second. If these dealers are willing to do this, right, unsecured business that create contingent liquidity, and they don't charge me anything for counterparty credit risk, maybe I should be on the other side of the trade and be a client and take advantage of all of those externalities that they're mispricing. It's not the derivative contract that may be mispriced. It's all those other factors that are being mispriced in his contract. He may not even need to take equity risk exposure at all. If he could just structure his trade in a way just to capture the fact that he's getting unsecured credit exposure, he's getting low-cost liquidity from these guys, that's the R, potentially. Not the fact that, Black-Scholes is right or wrong and the implied volatility, because it's related to all the things and lessons he learned in his 2002 business when he describes all the woes of derivatives. Well, all those woes are related to being a derivative dealer. Now, he highlights derivatives are dangerous. I think you sent out the thing about Fannie and Freddie. Well, this is very interesting because let me tell you, Fannie and Freddie, if you look at those financials and look at the contracts that they have, their derivative contracts were not that dissimilar in size than the derivatives that were held on the GRS balance sheet. And interestingly, when you look at their balance sheet, they have not a single option written in the derivatives business. It was all options purchased. And there was no regulator that required them to do that. They did that because that allowed them to reduce their economic risk to their mortgage book that had lots of options sold. So what they did, and their whole business model was buy mortgages, issue debt, hedge it. Use interest rate swaps to change the interest rate risk profile of the debt that I issue versus the interest rate risk profile of the assets that I'm buying. And those assets encountered big negative convexity, big writing of options, because mortgages are effectively callable at the discretion of the borrower. So in order to mitigate that, they prudently purchased derivatives, options. They had options, call options, put options, all purchased. So is an entity that engages in the purchase of options and is claimed to be speculative, is that really speculative compared to an entity that's now advocating naked sale of options? So an entity which is doing dangerous, which engaged in the purchase of options to hedge a risk, that's dangerous. But an entity that engages in naked selling of options because you think the price is right, that seems a bit more speculative. Now, he understands that derivatives are dangerous. He took a $400 million hit, as he reported. Now, here are all the things mispriced. I'm going to sell options on puts on 4 equity indices, 15 to 20 years. He's writing shorter dated credit default swaps. He's writing credit default swaps on single name. These are indices. Then he decided to do single names. We believe most of these are related to high yield names on 42 independent corporations. So while we know the derivatives are dangerous, there's wonderful opportunities to take advantage of mispricing. Well, we're going to have to ask some questions about these two, because I'm going to tell you something about credit derivatives. Okay, let me describe to you what the pricing of credit derivatives are. Right now, and we're going to try to figure out what the externality is. Right now, you can buy a high-yield bond with a spread, credit spread, on the cash security. Let's say 10%. So you're going to earn, let's say you get a spread over the short-term LIBOR rate of 10% over LIBOR. Okay, that's the cash bond. The credit derivative on that exact same name with the exact same maturity, perfectly matched, let's say that's 5%. So you can buy a bond with a credit spread, cash bond of 10%, and you can buy, and you can actually do a derivative with a spread of 5%. So the cash bond has an extra 5% more credit spread than the derivative. How is that possible? Does anyone have an idea? Why would the cash bond trade at a credit spread much, much wider than a credit default swap? Anyone have an idea? Balance sheet is definitely one, and you're getting warm. Now keep thinking. Balance sheet is definitely an issue, but there's another issue.
Liquidity.
You're getting there. I'll tell you. Nobody in the dealer business right now will lend you a single dollar against the high-yield corporate bond. So you can't leverage the corporate bond. So whereas the derivative still allows you to get big leverage, and the cash market doesn't let you get the leverage. So Mr. Buffett is potentially effectively buying high-yield credit leveraged and actually getting it at a yield way lower than he could if he did it in the cash market, which tells you what? It tells you how much he values his liquidity. Because he has a very low cost of funding. He could go buy that bond and finance it very inexpensively because he should be a low-cost funder, and then actually he could even buy the protection and just have a very nice spread on that trade. But he does this instead at a spread much tighter than where the bonds are. That trade is called negative basis. You have a negative basis when the credit protection is actually at a lower spread than where the cash bond is trading. And if you've got access to liquidity, that's a wonderful trade. You have the bond, you don't really have any default risk, and guys like PIMCO, who run the big total return fund, do that all day because they don't really need the leverage. They're unleveraged fixed income investors. And as a side note, as we're dealing with a Chrysler bankruptcy today, I'm going to offer you a thought that what is happening now is when you go into a bankruptcy situation, there are the people who own the bonds get on the credit committee. But nobody on the credit committee asks whether they have credit default protection. So there are people sitting on the credit committee of Chrysler saying, I'm not taking the 32 cent on the dollar deal with respect to these bonds. But they want the deal to crater because they own a lot of the bonds. They get on the credit committee. But they're going to profit because they probably bought more credit default protection than they have owned of the bonds. So when they see the recoveries go to zero, they're going to make a killing. Yet that guy is sitting on the credit committee. I'm not going to take that 32 cents. And who were those guys? Why did they do that? These hedge funds disagreed. Yeah, I guarantee you if you look at those hedge funds, they all have a ton of credit default protection. And they said, I'm not going to accept 32 cents. Yeah, because they want it to go to zero, because then they have a recovery of zero on the net. They have a net position where they are actually net short the bonds. Yet they're sitting on the credit committee influencing what's going on. Now that is troubling. Okay. Now, all of these things I can tell you. Flaws in black? No. Errors? No. All of this stuff? No. It all comes down to the value associated with the fact that he didn't have to put up collateral, and he's getting all this wonderful contingent liquidity. As you could see, those credit default swaps give you a clue. I mean, we can't say definitive anything. We're just looking at public information. But I'm just trying to dig under the cover as an experienced guy, looking at a trade that he did in credit default swaps, which you know he could have done better in the cash market, and he did it in derivatives, which say that he thinks the derivatives market is giving him a wonderful opportunity to get low-cost credit, low-cost float, because they're not requiring him to put up margin, and they're not requiring, and he's getting access to their liquidity. Because when he goes and writes those puts, where do they get the money to give to him? If they go and hedge it with somebody else, it's all going to be margined. So all of a sudden, they're going to give Buffett $7 billion. They're going to go and write options to another dealer, which is going to then give that guy $7 billion. But you know what that dealer is going to say? Give it back. I need it to cover the credit. So when they do that trade, the guy is sitting in the middle. He does a trade with Buffett. Buffett says he sells him an option, $7 billion. The dealer sends $7 billion over to Buffett. Now the dealer goes and lays off the risk by selling that to a dealer, but unfortunately, that dealer requires collateral. So when that dealer goes and sells it to the street, he then gets $7 billion. But then the problem is, because it needs to be collateralized, the counterparty then asks for the $7 billion right back to secure the exposure that that counterparty has to the premium. And you know what you get credited on that premium? So now you get the $7 billion of premium from the dealer that you have a collateral agreement with. You give it back out. And they do credit you a rate of interest. Unfortunately, that rate of interest is the Fed funds rate, which is basically 0. Okay? So therefore, you're earning 0 on your money that you're getting from the derivative dealer that you hedged, that you have collateral arrangements with. You sent a check to Mr. Buffett for $7 billion. Where does all that $7 billion come from? You issue unsecured debt at 4, 5, 6, 7%. Well, that means you're losing 4, 5, 6, 7% versus a Fed funds rate of 0 for the next 15 years. So Mr. Buffett certainly, I'm sure, recognizes that and so you have to ask your question, when we see these dealers have all incented to make huge mark-to-market profits, how can this not be caught? Why is it not being captured in the mark-to-market? The collateral arrangements, the expected future costs of your collateral arrangements get accrued. They don't get marked to market. So that loss of receiving Fed funds and paying unsecured debt to fund the premium you went to Mr. Buffett is a drip, 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 drip. Now, the drip is getting bigger because your cost of unsecured funding has gotten pretty high, and Fed funds is 0, but it's still a cruel drip. Nobody marks to market the expected cost of the liquidity mismatch that you have. And I won't discuss. There's trades that you can do. Let's put it that way on those types of transactions. So that's one thing. But then the other thing, which we saw Gen Re did mark to market, they did mark to market the credit risk. So you have to say, what is going on? Why is these dealers not taking huge losses when they do these uncollateralized transactions with Mr. Buffett? We saw Gen Re had a credit model to model the risk of credit default for their derivative book. So what are the possible explanations for that? Well, one of them we saw in the Gen Re disclosure. When we model up the credit risk, we use historical default probability. So maybe if you use historical default probabilities for Warren Buffett's company, that comes out with an expected cost of 0. That's one possibility. The other possibility is there are potential liquidity triggers, rating-based triggers, which say if the counterparty gets downgraded to a particular rating level, all of a sudden you need to come up with the collateral. And that would substantially mitigate and reduce the amount of the credit risk that you have to him, and therefore reduce the loss that they're incurring as a result of this credit exposure. So none of us, I don't know the answer to this. I'm just postulating the possibilities. But you know that these guys have big credit exposure in these contracts because they're uncollateralized. And since we know they mark to market their credit reserves, how can it be that guys that are so motivated by showing mark-to-market gains as part of their compensation, how could they be doing trades that de facto day one could show a big mark-to-market loss? That doesn't make sense. So either the credit risk models of these organizations that are the counterparties to him didn't properly price the credit risk, and it was not material because of faulty models, faulty assumptions, or there are very protective credit features in their contracts that protect them so that the credit risk of these deals with Mr. Buffett are limited. We don't know the answer. But I can tell you that the reason in the credit default swap market, the Berkshire Hathaway credit default swaps trade so wide because all of the dealers are buying credit default swap protection on Berkshire because they have, and it gets worse as the stock market goes down. The mark-to-market exposure of their gain, and therefore their exposure to Buffett gets bigger, so they have to go and buy more credit default protection. There's that two-factor type of risk and dynamics. You know, as the stock market goes down, they have more exposure. They have to buy more protection. As the stock market goes up, then they have to go and cover that protection. So if you think about those correlations, those guys could be losing money. They could be dynamically trading and losing money. The stock market goes up, and the credit spread widens. They need to buy more protection at higher spreads. As the stock market rallies and the exposure to Buffett goes down, they need to cover the protection they just bought and lock in a loss because the spread is coming down. So if there's positive correlation between his credit spreads and what's going on in the underlying asset, there is some negative convexity that's going on in the dynamic rebalancing that could be costing them more money, and you see the trading behavior taking place related to that. So I leave these questions about, now, this is one final thought. We've discussed all of these. Staying within your competency. This is an interesting one. Bad people. There's a risk that, we don't know what really is going on with those potentials for contingent collateral agreements on ratings. But those rating agencies have been at the heart of a lot of economic woe for people. Those guys rated lots of bonds that should never have been rated AAA. And now they're being very conservative in their thinking about ratings because they've been focused as one of the contributors to the mortgage crisis that we've had. And there's a risk that they become much more conservative in their thinking. And so to some extent, and I don't know what the realities are in those derivative contracts that Mr. Buffett has, but if they have contingent ratings-based thresholds that say when you hit this rating, you need to come up with the money based upon what the existing mark-to-market is there, you are now exposed to the whims of rating agencies. And you have to ask the question, is that a good position to be in which you are not in control of your destiny? And that is what I offer you with respect to this aspect. I don't know if they're bad people, but we have seen some certainly foolish behavior done by entities that could be influencing the liquidity of Berkshire to the extent that there are these rating-based requirements to come up with money. Now, I think we're...
And we should point out that Berkshire's debt
has been downgraded. Yeah. So it's so this in conclusion, my thesis would be that actually Mr. Buffett, who described derivatives as time bombs and financial weapons of mass destruction, should have put a bit of a caveat. It's not the contracts that are the weapons of mass destruction. It's the dealers that have been the weapons of mass destruction. So that's I think that's my last slide. Does anyone have any questions?
Doug, thanks very much. If you have questions, send them to me. When you reflect upon what you have heard, send them to me, and I will forward them.
And I will answer all the questions.
And we'll post the answers.
Yes.
Was there something inaccurate that we missed?
That you have to figure out. You can watch the video. I do not tell that. No, I started out by telling you that. Every class I give, there is a positive probability that I potentially say something wrong.
To see if they can.
So they pay attention, and number one, to pay attention, and number two, to lay down these seals, these kinds of all smart people. I want smart people to feel confident to be able to ask the presumed experts and challenge them and feel comfortable. I've seen a lot of people, smart people that sit back and they know what's being done is wrong. You need to speak up.
Oh, well, they speak up.
Right. Oh, the repeat performance. This is like a guy
This
that's...
time, he's going to pay attention. Okay.
But he can't answer any of the questions. That's disallowed.
Right. All right. So this is section B plus guests who were invited. So I want you to know this is twice the number of people. It may not look like much. Are we rolling? Okay, good. Then let me shut the door. Take your seat. So this is Doug Dachille, our guest speaker for today. And Doug and I first met at J.P. Morgan in 1999. He was the head of proprietary trading at the time, at the ripe old age of 34, I think.
Yep.
And making a lot of money for the company. And he was